Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Novanta Inc. Annual Report. Novanta Inc., a leading provider of precision medicine and manufacturing solutions, operates in two segments: automation enabling technologies and medical solutions. The company offers a wide range of products and services that cater to various industries. In the precision medicine and manufacturing segment, Novanta designs and manufactures laser beam delivery components, COTWO lasers, solid-state lasers, ultrafast lasers, optical and inductive encoders, precision motors, and motion control solutions. These products are used in advanced industrial processes, medical robotics, and life science automation applications. The medical solutions segment provides a variety of medical-grade technologies, including medical insufflators, pumps, laser beam delivery solutions, machine vision technologies, RFID technologies, barcode identification technologies, thermal chart recorders, light and color measurement technologies, touch panel displays, and advanced motion control solutions. These products are used in various medical procedures, such as ophthalmology applications. Novanta sells its products through a direct sales force and distributors under multiple brands, including Cambridge Technology, Synrad, Laser Quantum, and others. The company has been operating since 1968 and is headquartered in Bedford, Massachusetts. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what may cause a stock price to remain stagnant over a period of time. The stability of Novanta Inc.'s stock price in the past year can be attributed to several factors. One possible reason is that the company has maintained a consistent financial performance, with steady revenue growth and stable earnings per share. This consistency can lead to a lack of significant changes in the stock price as investors become accustomed to the company's predictable results. Another factor contributing to the stagnant stock price may be the absence of any major disruptions or challenges facing the company. Novanta Inc. may have successfully navigated industry trends, regulatory changes, and other external factors that could impact its operations and financials. As a result, investors may not see any compelling reasons to buy or sell the stock, leading to a stable but unremarkable price movement. Additionally, the overall market conditions may also play a role in Novanta Inc.'s stagnant stock price. If the broader market is experiencing a period of low volatility or a lack of significant economic changes, it can lead to a flat stock price for companies like Novanta Inc. that are not experiencing any major catalysts for growth or decline. In conclusion, the stability of Novanta Inc.'s stock price in the past year may be due to a combination of factors, including consistent financial performance, absence of disruptions, and overall market conditions. Novanta Inc. maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Novanta Inc. trades at a higher price-to-earnings ratio of 96 times and a higher price-to-book ratio of 6.33 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 46% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. Revenue growth drivers. A comprehensive overview. Revenue growth is a critical aspect of any business's success, and understanding its primary drivers is essential for informed decision-making. The extracted summaries highlight several key drivers that contribute to revenue growth or decline. At the core, changes in revenue growth rates from one period to another are a significant driver of revenue growth. Strong customer relationships and the presence of developed technologies also play a crucial role in driving revenue upwards. A strong brand or trade name can further contribute to revenue growth by establishing trust and loyalty with customers. Industry-specific drivers, such as advancements in medical technology or shifts in demand for automation and robotics, can have a significant impact on revenue growth. Regional revenue growth rates, country-specific drivers, and local economic conditions also influence revenue growth. In addition to these common and industry-specific drivers, other factors such as acquisitions and mergers, cost improvements, new product introductions, and changes in competition can drive revenue growth or decline. It is essential for businesses to consider these various drivers when developing strategies to achieve revenue growth. Ultimately, understanding the primary drivers of revenue growth or decline requires a comprehensive analysis of both internal and external factors. By identifying and addressing key drivers, businesses can make informed decisions to optimize their revenue growth and stay competitive in their respective markets. Net income and profit margins experienced significant fluctuations over the period. Initially, net income increased due to a registered public offering and acquisition of Kion Technologies, S. However, it decreased subsequently due to economic downturns, inflationary conditions, uncertainty about customer demand and budgets, geopolitical risks, higher manufacturing costs from tariffs and trade restrictions, decreased competitiveness of products, infringement claims by third parties, failure to protect intellectual property rights in foreign countries, increased competition leading to price reductions, integration challenges with newly acquired operations, supply chain disruptions, production difficulties, regulatory hurdles, shipping and delivery delays, changes in foreign currency rates, and increased costs associated with climate change and sustainability regulations. Profit margins also underwent significant changes. They initially expanded due to operational performance improvements through lean manufacturing principles and strategic sourcing initiatives. However, they decreased subsequently due to higher tariff costs, temporary cost increases in automation-enabling technologies, a one-time inventory-related charge, amortization of inventory fair value adjustment, costs associated with the planning and design phase of financial and operation system implementation, insurance recovery claim, increased costs from 2025 acquisition, increase in tax provision, contingent consideration adjustments, increased share-based compensation expense as a percentage of total revenue, and increased inventory levels. The decline in net income and profit margins can be attributed to various factors such as economic downturns, geopolitical risks, higher manufacturing costs, decreased competitiveness, integration challenges, supply chain disruptions, regulatory hurdles, changes in foreign currency rates, and increased costs associated with climate change and sustainability regulations. The company is indeed generating positive operating cash flow. This can be seen in the significant amounts of net cash provided by operating activities reported on various pages of the document. On page 41, it is stated that the company generated a substantial amount of net cash from operating activities, with $64.1 million in 2025 and $158.5 million in 2024. This indicates a consistent trend of generating positive operating cash flow over the past few years. Furthermore, on page 59, the cash provided by operating activities is reported to be $64,056 in 2025, $158,512 in 2024, and $120,075 in 2023. These figures demonstrate that the company has been able to generate a significant amount of cash from its operations, which is essential for meeting its future operating and capital expenditure needs. Overall, the data presented suggests that the company is generating sufficient positive operating cash flow to meet its financial obligations, indicating a healthy financial position. The company's debt levels have experienced fluctuations over the years. While there are instances where debt levels have increased, such as on page 41, where it rose to $224 million in 2025, other periods show a decrease. For example, page 55 notes that long-term debt decreased from $411,949 in 2024 to $212,538 in 2025. Similarly, page 77 indicates that total debt increased but long-term debt actually decreased. Interest expenses have generally trended downward. On page 35, interest expenses decreased by $0.31 basic EPS and $0.30 diluted EPS in 2025 compared to 2024. Page 38 also shows a decrease of $10,027,000 from $31,453,000 $489,000 to $21,472,000. However, page 48 notes an increase due to higher interest rates, but this is the only instance where interest expenses rose. Overall, while there are some instances of increased debt levels, the trend in interest expenses has been downward, with a few exceptions. Management is committed to driving sustainable and profitable growth through a combination of short-term and long-term initiatives. Key strategies include improving business mix, introducing new products, and deepening key account relationships with medical equipment manufacturers. The company also plans to pursue complementary medical technology acquisitions, increase penetration in high-growth industrial applications, and broaden its portfolio of enabling technologies. Management believes that the company's future operating cash flows will be sufficient to meet its needs for at least the next 12 months. To achieve this goal, the company intends to use cash held in foreign subsidiaries to fund local operations and acquisitions, and may utilize intercompany loans to address short-term cash flow needs. Additionally, management has authorized up to $200 million for share repurchases under the 2025 repurchase plan. The company's financial position is strong, with a significant amount of borrowing capacity available. Management has entered into a new credit agreement that provides for an aggregate credit facility of approximately $1 billion and has increased the maximum consolidated leverage ratio permitted under the agreement to 3.75:1. This will enable the company to continue investing in its growth initiatives while maintaining a healthy financial position. Overall, management's strategy is focused on driving sustainable growth through a combination of organic and inorganic initiatives, while also prioritizing operational performance and people development. The company's strong financial position and commitment to innovation will enable it to continue delivering value to shareholders and customers alike. The company has made significant moves through acquisitions and divestitures. In terms of acquisitions, the most notable one is the purchase of Kion Technologies, SL, a provider of RFID solutions, for €64.8 million or approximately $71 million. This acquisition is expected to bring in new technologies and opportunities for growth. In addition to this major acquisition, the company has also identified complementary businesses and technologies that it plans to pursue. These opportunities are mentioned on page 26 of the document, but no further details are provided at this time. On the other hand, the company has also engaged in divestitures as part of its strategic plan. A series of strategic divestitures were mentioned on page 1, although specific details about these transactions are not available. It is clear that the company is actively managing its portfolio and making deliberate decisions to sell off certain assets or businesses. The company's financial activities have been a subject of interest for investors and analysts. A review of the company's records reveals that it has not paid any dividends to its shareholders. This decision may be attributed to various factors, including the company's focus on reinvesting profits into its operations or maintaining a strong cash reserve. On the other hand, the company has indeed engaged in share buybacks. This strategy allows the company to reduce the number of outstanding shares, thereby increasing earnings per share and potentially boosting investor confidence. The decision to buy back shares may be seen as a vote of confidence by management in the company's future prospects. Concerns about inventory buildup and supply chain disruption are evident throughout the extracted summaries. One of the primary concerns is the risk of inventory buildup due to overestimating component and raw material requirements, which could lead to increased costs and delayed production, page 19. This is further exacerbated by the reliance on OEM customers, whose inventory positions and economic conditions can disrupt supply chains, page 24. The company's purchase obligations also pose a significant risk, with $160.3 million payable within the next 12 months, page 43. Additionally, the provision for inventory excess and obsolescence has increased significantly over the past 3 years, indicating potential issues with inventory management, page 59. The growth in raw materials, work in process, and finished goods inventories also suggests a buildup of inventory levels, page 75. Furthermore, the company's reliance on limited suppliers for certain raw materials, components, and parts creates a risk of supply chain disruption, page 6. Long product lead times and increased component outsourcing to manufacturers in different countries also contribute to this risk, pages 14 and 16. Disruptions in IT infrastructure and potential delays in system upgrades could further exacerbate supply chain issues, page 23. Overall, the concerns about inventory buildup and supply chain disruption are widespread and indicate potential risks that could negatively impact the company's business operations. That concludes the financial summary for Novanta Inc. Feel free to comment below, and I will be happy to answer them when possible.